The government gives you a lot of tax-favored options in helping you save for retirement. One that a lot of people have access to at their places of employment is called a 401k. And basically what it lets you do is take money out of your paycheck and put it in a special account where it gets to grow on a tax-deferred basis until you decide to take it out for retirement. Now, depending on where you work, the employer plan that you may have access to may not actually be called a 401k. What the name 401k refers to is a section of the tax code that makes these plans possible. But there are other parts of the tax code that make plans possible for other employers. For instance, if you work for a nonprofit organization or if you work for a government agency, then you may have access to what's called a 403b. On the other hand, there's another type of plan called a 457 plan. So numbers abound, but the same general idea works regardless of which one you're talking about. One benefit of 401ks and one incentive that the government gives you to contribute to them is that any money that you put into a 401k doesn't get included in your taxable income for that year. So basically, you get to contribute pre-tax money and you don't have to pay income tax on that money after you contribute it. In addition, employers often add extra money on top of the contributions that you make. Some of that money comes in the form of what's called matching contributions or employer matching, where your employer may decide that to match a portion of the money that you put in to your own account. In addition, other employers may decide to make what's known as profit sharing contributions, where if a business is profitable for a year, the company will share those profits with their employees by making additional contributions. In general, those contributions will hinge on your working with that company for a given period of time. One common period of time is about 3 years. If you leave the company before then you may have to forfeit the money that your employer gave. Any money that you put in, on the other hand, is always yours to keep, no matter when you decide to leave the company. One reason why people aren't as happy about 401ks as you might think is that many employers don't take the time to set up investment options that are the best possible. One thing about 401ks that differ from other types of retirement accounts, like IRAs, is that you don't get to pick whatever investment you want to put your money in for retirement. Instead, because your employer sets up the plan, it's your employer who picks which investments are available for you to put your money. And in many cases, employers aren't smart about picking good choices that offer reasonable costs to let you invest the way that you want. The amount of money you can save in a 401k is so large that most people never even get close to maxing out their annual contribution. People who are younger than 50 years old can put $17,000 into a 401k in 2012. If you're 50 or older, you get to add an additional $5,500 to that amount. As you can see, many people will never get close, but just because you can't contribute that maximum doesn't mean that you can't get really good benefits from putting whatever you can into a 401k. One thing to remember about a 401k is that money is really for retirement. And so if you ever need to get at the money before you retire, you can expect to have to pay a penalty. That penalty that the IRS puts on early withdrawals in most cases is 10%. And in addition, any money that you take out of a 401k before retirement age is going to be included on your tax return for that year. So what that means is that even if you do have to access that money early, you really don't have the full value of what you take out, because the tax burden on that money ends up being really relatively big. Despite the limitations that 401ks have, and despite the fact that you have to be willing to put your money aside for the long haul, 401ks are really a great way to save for retirement, especially in situations where employers are helping you by making contributions on top of what you put in. The fact that you can get tax-deferred growth and not have to worry about taxes throughout your career really makes a boost to your retirement nest egg if you use a 401k.